Okay, so what if I told you there was a way, an investment strategy that could add, I'm talking hundreds of thousands of dollars to your net worth, and you wouldn't have to take on a single extra ounce of market risk? Sounds too good to be true, right? Well, today we're going to pull back the curtain on the overlooked but super powerful idea of asset location. So let me just start by asking you this. Are you making this really costly investment mistake? Most of us, we spend all our time and energy thinking about what to buy, which stock, which fund, but we completely ignore an equally important question, and that oversight could be costing you big time.
And look, we've all heard of asset allocation, right? It's like investing 101, deciding your mix of stocks and bonds and all that stuff. And don't get me wrong, it's absolutely critical. But here's the thing you might not realize. It's only half the story.
The other half, well, that involves fighting this hidden enemy that is just silently eating away your returns year after year. It's called tax drag, and it's caused by what the pros call location errors, which is just a fancy way of saying you're making the costly mistake of ignoring where you hold your assets. Okay, so let's dive in. Here's what we're going to cover. First, we'll shine a light on that hidden tax drag. Then, we'll talk about how to unlock something called tax alpha. After that, we'll get a handle on your three main investment silos, learn the rules of the road for location, and finally, piece it all together into a much smarter long-term strategy. All right, so let's talk about this hidden tax drag. What is it really? Think of it like this. Every single year, taxes on dividends, on capital gains, they act like a tiny, slow leak in your portfolio, just drip, 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 chipping away at your growth. Understanding where those leaks are happening is the very first step to plugging them for good. But, and this is the good news, there is a solution. It's this powerful idea called asset location. And what's so great about it is that it's all about getting a real performance edge without having to gamble on riskier and riskier investments. So put simply, asset location is just the art and science of putting the right investments into the right type of account. The whole goal is to minimize the taxes you pay over your lifetime. And when you nail this, you generate something called tax alpha. And that's just a cool term for the extra return you get, basically for free, just by being smart about taxes. And the impact, it's not small. We're talking staggering numbers here. Get this, according to research from Morningstar, if you have $1 million portfolio, getting your asset location right can boost its value at retirement by an average of $112,000. That's a huge difference.
And what's really cool is how this benefit just keeps building on itself. It compounds. Some of the big financial firms have found that a smart strategy can add anywhere from 20 to 50 basis points to your returns every single year. And a basis point, if you're not familiar, is just 1/100%. So we're talking about an extra 0.2 to 0.5% gain just from being tax smart. That adds up fast.
And check this out. This table really shows how this works in the real world. The higher your tax bracket, the more you stand to gain. It's that simple. Look at someone in the 37% federal bracket. The potential boost is over 100 basis points. That's a full percentage point of extra return just from being efficient with your taxes. That's wild. Okay, so before we can really put this strategy to work, we got to understand the tools of the trade. The easiest way to think about it is that your investment world is split into three main silos or account types, and each one plays by a totally different set of tax rules. So, the first big split is between your regular taxable accounts and your tax-advantaged ones. In a normal taxable brokerage account, you're paying taxes on dividends and capital gains pretty much as they happen. But in tax-advantaged accounts, your IRAs, your 401ks, your investments are basically in a protective bubble, sheltered from those annual taxes, and that lets them compound way more freely. Now, inside that tax-advantaged world, you've got two main flavors. First, there's tax-deferred. That's your traditional IRA or 401k. Think of it as pay taxes later. You might get a tax break now, but you pay income tax when you take the money out. Then you have tax-free, which is the Roth. This is pay taxes now. You contribute with after-tax money, but then everything, the growth, the qualified withdrawals and retirement, it's all 100% tax-free. So the big question you have to ask yourself is, do you want to pay the tax man now or pay him later? All right, now we get to the really good stuff, the how-to. We know the different accounts, we know what we're trying to do, so let's lay out a simple framework for deciding which investments go where. Okay, first up, let's talk about what you want to shove into those tax-advantaged accounts, your IRAs and 401ks.
These are what we call tax-inefficient assets. So think about things like corporate bonds or REITs, which are kind of like mutual funds for real estate. They tend to kick off a lot of income that gets taxed at your highest rates. Even something like TIPS, these are inflation-protected bonds, they can create this taxable phantom income that you have to pay tax on, but you never even see the cash. So sheltering these guys from taxes should be your #1 priority.
Now, on the flip side, you've got your tax-efficient assets. These are the ones that can live quite happily in a regular taxable account without causing a lot of tax drag. A perfect example is municipal bonds. The interest they pay is already tax-exempt, so sticking them in an IRA would be totally pointless, right? It's like putting a raincoat on a fish. And your broad, low-turnover index funds and ETFs, they're literally designed to be tax-efficient right out of the box.
So, this matrix right here, this is basically the ultimate cheat sheet. It pulls it all together and shows you where to put your key assets to get the best results. But look closely, the real home run, the grand slam, is putting your highest growth potential stocks into a Roth account. And why is that? It's simple. You want your most explosive growth, your biggest winners, to happen in the one account where all of that growth will be 100% tax-free forever.
But wait, there's more. The power of asset location doesn't just stop once you're done saving for retirement. Oh no. It is just as critical for figuring out how you spend your money in retirement. And this gets into a really cool concept called withdrawal sequencing. So for decades, the old school advice for retirement withdrawals was always the same. You follow this simple sequence. Spend down your taxable accounts first. Then you move on to your tax-deferred accounts, and you save that beautiful tax-free Roth money for the very end. It's simple, sure, but it has one major flaw. See, that traditional approach, it often creates what you could call a tax bomb or a tax mountain later in your retirement. Your tax bill starts low, but then skyrockets. A much smarter, more modern approach is to withdraw proportionally. You take a little bit from each account type every year. This smooths out your tax journey completely. In fact, Fidelity ran the numbers and found that this simple shift can cut an investor's lifetime tax bill by over 40%. Not only that, but it can actually make their money last longer. That's a game changer. And really, that brings us to the absolute heart of this whole idea, and it's captured perfectly in this quote. This ability to minimize tax drag just by optimizing the structure of your accounts. It's one of the few truly reliable ways you can enhance your portfolio's returns without having to take on more and more market risk. So look, if you take away just one thing from all this, let it be this. Proper asset location forces you to stop thinking about your 401k, your IRA, and your brokerage account as separate, isolated buckets. Instead, it helps you see them for what they are, a single, coordinated, and highly optimized engine for building long-term wealth. Which really leaves us with just one final, crucial question you need to ask yourself. You've probably spent a lot of time and energy making sure your portfolio is properly allocated, but have you spent any time making sure it's properly located?